Well, good afternoon, everyone, and welcome to the latest in our series of professional advisors working lunches. With today's partner, Schroders. I'm Andrew O'Kelly with Professional Advisor, and I'll be your host for today. But before we start today's session, let me just go through briefly the obligatory housekeeping notes. Your microphones and cameras are currently switched off, and we'd be most grateful if you'd be kind enough to keep them that way. Just ensures there's no background noise so the speakers can be heard more clearly. For those of you with either a nickname or simply your Christian name against your screen icon, please could you just take a look out for the chat function on the sidebar of the screen, where you'll probably receive a message from my colleague Joe just to establish who you are. It's not Big Brother stuff, it's just simply so we can ensure that you receive your CPD certificate after the event. As usual, we'll have an allocated time at the end of the session for Q&A, but do feel free to ask questions all the way through, and I'll pose those to our speakers. And you can post questions using the chat function, which you'll find at the bottom of your screen. And as I said, whether it's during the session or at the end, we'll endeavour to address all your questions in the time we have allocated. I should also inform you that the session is being recorded, and we'll send you a link to the recording by tomorrow. Please do feel free to share this with all your colleagues, of course. As usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you a proof of attendance along with the link of the recording of this session later today. Now, onto the programme. Research highlights that over the next decade, £1 trillion worth of assets will flow to future generations. And an astounding 65% of those inheriting wealth are unlikely to use the same financial advisors as those passing on their wealth. Now, this next generation of investors may be perceived as low value and uninterested in saving by financial planners. But is this a ticking time bomb? And is it an accurate portrayal? In fact, 2.3 million of UK consumers hold crypto assets, and 74% of those users are aged between 25 and 44. And given this backdrop, are financial planners truly well positioned to maximise this opportunity? And perhaps more importantly, how do they engage with this next generation? So over the next hour, I'm joined by Schroders Director of Intermediary Solutions, Gillian Hepburn, and from the advisor community is a great friend of Professional Advisor, Philip Martin, the Managing Director of Unique Financial Planning. And this is the really thought-provoking question that they'll be discussing today. So without further ado, let me introduce you to Schroders' Gillian Hepburn. Afternoon, Gillian.
Afternoon, and delighted to be here. I'll just kick off. So thanks for that introduction, Andrew. And intergenerational wealth transfer has been talked about lots in the industry over the last few years. But I started to think about this from a completely different angle earlier this year, which I guess prompted some of this conversation that we'll have this morning, or this afternoon as it is now. What is happening with the next generation? How are they engaging, and what are they up to? And should we actually care? So hopefully by the end of the session, we should be able to understand the rise of investing in crypto and Bitcoin amongst that younger generation. Consider whether or not it's an issue for your business. And that actually is a very interesting question, just based on some of the conversations I'm hearing in the industry. But is it an issue? And if so, how might it relate to your wealth transfer strategy? And then if it's a challenge, then what do we actually do about it? Because I'm always keen that we don't just talk about the background, the research, but how do we translate that into practical action for you and your business? So some interesting learning objectives. But I thought I would start this from more of a personal perspective. So I'm just going to share something which might resonate with many of us on the call. But I have a son.
Yeah. Gillian, sorry, I'm so sorry to do this, to interrupt. I'm just getting a few comments here that you sound a little bit quiet. I wonder if you mind just if you could speak up just a wee bit. I'm sure that would help. Thank you.
Yeah, no worries. Maybe we should just check where my microphone's coming from. Is that any better, Andrew?
Much the same, Gillian, I think.
We might just need to ask you to speak up a wee bit, and
okay.
Thank you.
Rather we got this resolved straight away. Is that any better?
I think so, yes.
Okay, let's go for it, and I'll speak as loud as I can. But any problems, do stick it in the chat, and I'm sure Andrew will keep me up to date.
I will.
But essentially, I started to think about this topic primarily after a conversation with my son, and it's always interesting, isn't it, to add a personal perspective onto something. But I'll share. He's 24, and he's got a mum and a dad, and each of those have some property. Um, Very fortunate to have been in financial services for many years, so a DB pension scheme and some investments. So certainly interesting from his perspective. But what's he like? Well, like typical 24-year-olds, he doesn't read newspapers, he doesn't have a TV license, he doesn't have a car, he doesn't have a watch. But apart from that, he's kind of pretty average, really. And the interesting thing is he expects everything now, and it all sits on this thing here on his phone. But he's pretty normal in lots of ways. But let's dig a little bit deeper. And interestingly, he's already inherited some wealth. And this is something I hear a lot about the next generation. They're not going to inherit wealth for a long time. Well, fortunately for him, a grandparent decided to skip a generation. So there's already a little bit of cash moved in his direction. He's got some savings from a part-time job. If anybody wants to know how much a delivery driver earns, it's enough to have the tax man looking at you, even although he was a student at the time. He's already got a mortgage. Interestingly, he maybe being he's a bit of a saver. I was going to say, but Philip and I are both Scottish, so maybe there's a Scottish thing in there. But he's got a buy-to-let mortgage, but he's just also interestingly moved to Dubai, because he's a sports scientist and got his first job. Now, interesting, as a 24-year-old who is likely to inherit some wealth at some point and doing not too badly, there's three potential advisors in his life that could have engaged with him. So mine, his dad's, and the advisor that sold the buy-to-let mortgage. But actually, there's been no engagement whatsoever. Now, is it because he's perceived as essentially a low-value client, or actually we might speak to him, but just as a bit of a favour? And my argument here is it would have been quite simple to engage with him, to phone him up and just to say, we hear you've got a job in Dubai, well done. Do you understand what the tax rules are when you earn some income in what feels to him as a tax-free environment? So maybe there's a point here about engagement doesn't always need to equate to profit, which we'll come on to. But interestingly, or more interestingly, certainly from my perspective, somebody is engaging with him. He's engaging on his phone. He's seeing all sorts of interesting adverts through things like TikTok, for example, which can lead to some interesting views on investment. That middle slide here, I don't know if you can read in yellow, which I highlighted. Bitcoin is an exciting market to get your teeth into. It can springboard you to success. So interestingly, the information that they're being pushed online, and I'd love to see some of that text in a suitability report. So it gives them some interesting, ideas about investing, and they're all on chat functions as well, speaking to each other about how much they're earning. I love this last statistic about the number of Gen Z, so that's 23 to 38-year-olds, actually investing online whilst they're drinking their espresso martinis. So we definitely have a different generation that are behaving differently from how we might think they should be, but certainly engaged with investment in some shape or form. But going back to my son, I learned very quickly that all his money was in crypto. That was an interesting discussion with him. But when you actually see some of the adverts that are being pushed to that generation, well, why wouldn't you maybe be seduced by some of the claims? And they're certainly there for some powerful forces at play to engage with them. The quote on the right-hand side here, interestingly, comes from the regulator. So they're identifying what's happening here. Young people attracted by the thrill of investing. And what we're seeing is a lot of herd mentality in terms of what they're doing and actually how they're doing it. But I did go onto TikTok actually for some of this research. Very, very scary. But let's not be too quick to criticize them. That generation have had a really challenging time during lockdown. Many of them feel stressed. They're worried about their personal financial situation. We've all seen the statistics about student debt, on average £45,000. Financial vulnerability amongst that age group rose by 40% during the pandemic. You know, they can't get out of the house. Many of them have moved back into the family home, or quite simply can't leave the family home. So I always say, you know, let's understand why they're doing what they're doing. But actually, is it a challenge, or do we just ignore them and think, you know, they're just gambling, and you know, why should we really bother? Well, maybe the question is, could it, i.e., advice and financial services, all just end up like this? And I love the analogy of the, you know, the travel agents, where I talk about the olden days where we used to go in having read through lots of brochures, and somebody made a nice phone call and told us that there was a, you know, that full board was still available and there was still a family room, and yet there was a Scottish flight supplement for people like Philip and I. But you know, it was very much a face-to-face experience. And actually, are we heading in that direction ourselves with what I call, you know, the executive club in terms of the travel situation? So we go in and we have tailor-made bespoke holidays, and everything else is digital. So are we actually encouraging now an environment where that is going to happen? And that might be fine, because actually, you know, RDR, I think, has been one of the primary drivers for all of this. You know, advisors, those of you on the call, we've all behaved rationally, we professionalised the business. But actually, an interesting statistic is that the average age of the client base is certainly not in that younger demographic. You know, 9% of advisors told us in our annual advisor survey that their client base was on average aged between 20 and 50. And what we're now seeing is the client minimums reducing. So the number of advisors prepared to advise clients with less than £50,000 to invest is decreasing all the time. So we've got some interesting challenges, I think. But you know, it's back to this question, and this is where I'm going to bring Philip into the conversation. You know, should we just ignore that next generation and the way that they're behaving? Or is that potentially a challenge for us, and to start to think about addressing it? You know, Philip, I've probably talked too much already, but what's your take on this in terms of how that generation are behaving, and why should we worry?
Well, I think whether you need to worry, it for me is really driven by the sort of advice business you're running yourself. I think if you're running your advice business to generate income for yourself, you know, or others, and it's purely for income, I don't think you need to worry as much. You just want to try and maximize that income and continue to see it generated. But I think if you're running a business to try and maximize its capital value at some point down the line, I think you absolutely have to engage with this, because if you don't, the assets are going to fly out the door to somebody else who has engaged with that as they start to inherit. I mean, it is one of the principal reasons why we're a multidisciplinary practice, not just investment and protection, but also mortgages. And that's entirely because we do want to have a proposition, a non-investing type proposition, that we can start to engage with the children and relatives of existing clients. And it's a perfect, straightforward way to engage with them at an early age and start to build a relationship. So I wouldn't regard any younger person as anything other than a sensible, potentially for a short period of time, a loss leader, but a very, very sensible way to start to engage with a different cohort, and essential for capital value.
I think that's the point, isn't it? You know, are they a loss leader, or should we just let them get on with it until the point where actually they're interested in financial advice? I guess is the challenge. And I was at a conference earlier this week where somebody very senior in the industry actually said, we just need to ignore all these people that are on, you know, buying Bitcoin and crypto and doing all that stuff, because we just want to manage older, wealthy people. I just feel that's slightly short-sighted. I don't know about your thoughts, Philip.
I think it's the most preposterous thing I've ever heard in my life. And for the leader of the United Kingdom's largest life company to be taking that view is utterly ridiculous. I mean, what relationship-driven business decides that it isn't going to have a relationship for a period of time, but fully expects to have one in the fullness of time? I mean, it's nonsense. I mean, you just instantly dismiss it, I think. I think just because, I mean, mortgages is a good example because there's a need there. So giving advice on mortgages to somebody who wants a mortgage is obviously far easier than trying to persuade somebody to save who doesn't want to spend their money in saving. Self-evidently, it's more straightforward. But I think having a proposition that you can start to build that relationship at an early age is very important. It's not a loss leader at all, because you're expecting that to have absolute longevity. So I think that makes no sense to me at all. I think it's clear, you can see it from the rise of crypto. I mean, wouldn't we all love to be, describing things in an unregulated fashion? And that, it clearly helps in terms of the marketing position. But just because it's unregulated and we can't recommend it doesn't mean we can't be talking to people about it or explaining how it should, it could have its place in people who want to be more speculative, but explaining to younger people the value of diversification, why it makes sense, separating out cash that you're going to need with certainty from something that's more speculative and a bit punting. There's all sorts of ways, I think, that we can talk to that cohort without necessarily feeling that we can't go there because we're not regulated to talk about it.
Yeah, really, really interesting point. If we look at just some of these other slides that we put together, I mean, we've probably seen some of this data before in terms of advisor practices losing value because they don't have a connection to the next generation. I think the latest one I saw was that less than 14% of advisor firms actually have that connection to the next generation. And interestingly, while 65% of that next generation say they won't use their parents' advisor when they receive the inheritance, they actually still want to see an advisor at that point. So I guess the challenge is, by the time they get to that position and they're highly engaged online, will it be a hybrid advisor that they actually want to see rather than somebody that their parents met with? So I think we have an interesting challenge here in terms of how they might behave. I think
that last statistic, the 65% wouldn't engage with their parents' financial advisor. It'd be very interesting to know what that statistic is if they already have a relationship with that advisor, or have already heard from them, or have already sat in a meeting. I would guess it will be substantially different.
Yeah, so it's back to my earlier point of just being, making that next generation aware that you even exist. And, it really struck a chord with me in terms of my son and the fact that, there's opportunities just to have a simple conversation. And then it's in the mind, when I need advice, I know who to go to, rather than necessarily going to the person or it's not even a person, the technology that I'm using at the moment to invest and purchase Bitcoin. So I think there's some interesting dynamics here. And advisors often say, well, how long have I got? Because we hear, and Andrew mentioned some of the statistics earlier, that we often talk, I think, far too long term. So we talk about 5.5 trillion, so a wall of money moving across the generation over the next 30 years. And I think my argument here would be, actually, it's happening now, or we need to take action now, because the big bad wolf is out to get us, happily eat our dinner. And the more that these young people engage differently, then the less likely they are to come to what we would see as if I could call it, a traditional advisor. So we're almost letting them get away, if that makes sense. Yeah.
I think that's totally right. I mean, I think anybody that expects not to talk to that cohort for 15, 20 years until it has amassed a pot that they regard as sensible enough to engage, I think is going to be in for a really rude awakening. It's just not going to happen. You can't reignite a relationship that hasn't been there and just expect it as you're right. I just don't see it's going to happen.
Yeah, I mean, I often talk about turning up at the reading of the will is just quite simply too late.
Yeah.
And what we're seeing is, these young people, often in their early 20s now, absolutely engaging with finances, but just not in a traditional way, in the way that we would normally expect. And I think probably we do need to sit up and take notice and think about then how, what is the impact on our business, and what should we do? And we've probably talked about this before, but a great starting point, and many advisors have said that seeing this slide here has made them just sit back and do a quick analysis on their business. How many people have they got within a certain segment, 75, 80, whatever the number is. What is their marital status? What's the fee income? What's the family and the level of engagement? And, if I don't engage with them, what might be the impact on the business if I have low engagement, if that money moves out of the business when it reaches that next generation, then what does that look like? So, and I often add in, is the value of the family property at risk? We all know what property prices are doing and valuations. And again, that becomes a liquid, what is an illiquid asset at the moment, becoming potentially liquid and moving into the estate. So So actually doing a quick audit and thinking about it is a great starting point. Philip, is that some work that you've maybe done within your own business?
Yes, not on the entire client base, but certainly on the bigger, more significant client base. I mean, I think you're sort of beginning to now touch on some of the strategies that you can be using here. I mean, I think you know, there are many. Understanding your vulnerability is definitely important, but I think we've got a great opportunity. It's one of the few silver linings, I think, from the last 2 years, is the pace at which we've had to adopt technology that otherwise I suspect would never have happened in the industry, certainly not with that rapidity, you know, like electronic signatures and, you know, remote meetings. And the one interesting thing that's been happening, I think, that our advisors notice is that it's far easier, well, both to get both partners in the same place, which was traditionally quite tricky at the same time, but actually also to get extended family in and on part of a meeting when it's been held remotely across Zoom or FaceTime or Teams or whatever it happens to be. And I think that should start to become the norm for those clients who are comfortable with their extended family understanding elements of their financial plan. And that of itself just starts to build a relationship. Then I've almost got permission to start to talk to those relatives, to send them articles that are of interest to them, perhaps not to their parents, but certainly to them. And that's what we're working on a rolling basis. How can we sensibly get in front of that next generation, not just, you know, to try and sell them something, but just to start to build a relationship.
Yeah, that's a really interesting point, actually, Philip, because on a webinar that I did recently, an advisor asked me about the GDPR issues on sending newsletters to that next generation. And we talked about ways that we can actually address that, but obviously getting them involved in the family conversation as early as possible really gives you a starting point on that one. Yeah.
I think that's right. And I think there's an interesting question that somebody's just put on, actually, Gillian, that's a sort of extension of this, making the point that we're perhaps fighting a YouTube type generational gap where people under 40 think they can get all their answers straight to themselves. And you know, this particular advisor, it's Kevin White, is saying, I've already had to sort a couple of these out. I mean, this is the same phenomenon that says you don't need to spend 7 years becoming a doctor now, you just Google it, don't you?
Absolutely.
Absolutely. Everybody's got their own view on how medicine needs to be practiced. And I think that's right. So I think we can either, you know, rage at the machine with that, or we can start to provide, you know, context, you know, an alternative view, not to rubbish, you know, crypto as a specific example, but as I said earlier, to start to see how it can form part of balanced planning rather than what's currently happening, which is very, very unbalanced, obviously.
Yeah, absolutely right. And it probably relates to this next slide. And I picked this up because I did start to think when I was developing all this, kind of the whole theme and the concept was, you know, are we just confusing the two at the end of the day? Are we confusing this get rich quick mentality with what we do, which is, you know, financial planning? And it was really interesting. I read a great article by a millennial who said of advisors and the asset management industry, I'm not in their world, so they need to get into mine. So it's quite a sobering thought, isn't it, in terms of those attitudes and views. And I guess starting then to think about, you know, what do we do here? And often we've talked about, it's not just simply about, you know, hiring a millennial, or in this case, you know, getting onto TikTok, although it's dead interesting, actually. The FCA have gone onto TikTok. So clearly there's opportunities here. I still need to look at the feed, actually, but clearly we need to think about this in a different way. And back to your point, you know, maybe we don't make profit, but do we have a proposition? And because we're also in an environment now, aren't we, where the regulator is encouraging, you know, innovation, digital engagement, and event-driven advice. So the whole way that we think about how we approach that next generation, you know, is definitely changing.
Agreed. Yeah, agreed.
Yeah. So I mean, but taking this a stage further, I do think we often also underestimate that next generation in terms of their needs and requirements for advice. You know, this was some research that we did into millennials, where we looked across the whole cohort, because, you know, the top end of the millennials is now reaching the age of 40. And what they told us was, you know, as we split them up into different groups, because they do behave very differently as a cohort. I know by the time they reach sort of 31 to 36, they absolutely care about long-term future security goals. So things like saving for their family and pensions. So again, it's about let's not just apply stereotypes in terms of what that next generation looks like, or just assume all the time that there are not opportunities to give them advice. But one of the things I've also talked about, and I think it'd be interesting to explore with you, Philip, but about engaging with them. Can we actually use, dare I say, TikTok language? Can we just talk to them differently? I've got this great slide that we've used a few times on the beauty of pensions, which I actually think we should scrub that word out and talk about the beauty of thinking about your future income. But if I talk TikTok language for a minute, I can double your money. I did use this with my son just to test it out. But if we think about buying let's talk about it in terms of, this actually should be an espresso martini, not a glass of wine. But if you put £4 into a contribution and you get tax relief, or let's just call it a little bonus for being a good citizen and saving. So it gets topped up, and if you're in an employer-sponsored scheme, you might get a matching contribution. Well, suddenly, in order to make a £10 contribution, you've only had to put in £4. So immediately we can double your money, because if I offered you a glass of wine or a pint of beer, the cost price is 10 and you only have to pay 4. Who's going to say no? So I think we need to just think about, don't we, how can we express some of this stuff that we do in different types of language?
Yeah, I don't want to be a compliance board, but I don't want to pick you up on your arithmetic, but that's somewhat more than double your money, isn't it?
Slightly don't work, but you get the drift.
Yeah, no, I absolutely get the drift, and I think this is a constant challenge, isn't it? I mean, how on earth can you use, TikTok is all about accessibility, snappiness, and brevity. What's going to take longer to read the footer out than it is to actually put any content in, isn't it? And it's the constant challenge in our industry, how to be able to market given the huge numbers of restrictions that are placed on us in terms of how we how we say things. So I think, but that doesn't make it impossible. I mean, it can be educational, can't it? It doesn't always need to have a selling point to it. And I suspect that the route in is going to be far more around educational content than it is necessarily as a sales or drive up volume tool.
No, you're absolutely right. And I think education is absolutely vital in this space. And I love this next slide that we spotted was all around what are people searching for on Google, and what are we talking about? No big surprise, but when you see the figures again, really interesting that people are Googling, the top searches were ETFs and cryptocurrency. What we're talking about is equities and mutual funds. So, we need to understand our target audience and what they want, what they are interested in, and how we need to talk to them. And I think another form of education is, again, just thinking about, how do we educate ourselves in order to educate that next generation or our wider customer base. I think Andrew mentioned the stats up front about the number of people now in the UK holding some form of cryptocurrency. I know I'm sometimes challenged by really understanding all about this. How do you mine for something that doesn't exist? So there's a piece around educating, but we need to be educated. But I just loved, we've all seen these charts before in terms of, I like to call them the tartan chart, being Scottish, but we all know the argument about different asset classes behaving differently at different time points. Wouldn't it be great if we could map crypto onto this to help think about volatility, but to help paint pictures rather than use the volatility word? So I think we all have a part to play here, and think about how can we educate the next generation, but how do we educate ourselves to have that conversation? And Johanna Kirkland here at Schroders, who's our Chief Investment Officer, wrote a great article on this, and she said, whilst I don't consider Bitcoin to be a sensible investment, I think the collection of technologies it represents could have major impacts on our future. She does end her article by saying, perhaps I'll buy £100 worth just to shut the millennials up. Actually, when I spoke to her, she said, what I really meant was, I need to understand what this is all about. And maybe by going online and doing it, I'll see what's happening, and I'll see the information that these people are getting, the next generation, in order to invest in that way. So I think educate and be educated is a really interesting concept. But you alluded to that, Philip, when we spoke.
Yeah, I mean, I think, I mean, this is a really difficult area, isn't it? Because most investment professionals would take that view. I mean, heaven knows what the regulator, if it were regulated, how on earth the regulator is going to manage the price ramping that goes up, around the promotion of, of a new launch. Just would be an absolute nightmare. I mean, I think the point you're making earlier on about not being too critical of younger people making that call, it's easy to say, but we're not carrying 35 grand's worth of debt, are we? And
exactly.
A big old get rich quick scheme that can start to look like a way to dig yourself out of that hole is quite attractive. But so it feels to me that the way to approach this is not to say don't put your £100 into crypto. The right answer is probably carry on investing, but put 80 into crypto and put 20 into something a bit more mainstream to start, and build it up gradually and start to bank your winnings. In essence, take the stake off the table, explain how to take risk off the table. And so there's all sorts of ways I think that you can start to move that conversation away to what I think we would probably all agree is a far more acceptable and sensible planning outcome. But the answer is not to say stop buying it, because that is just not going to happen, is it?
No, not in the short term. And it was really interesting doing the research and speaking to some not even millennials. I think they're a different gen. I get lost with all the different terminology. But when I spoke to my son about what he and his friends are all doing, there is this bit around herd mentality. Everybody else is doing this, and to use your phrase here, which was interesting, winning as opposed to investing. It was really interesting the way they engage with each other and how it becomes this whole fear of missing out. But my concern was, well, when you really start to inherit money or earn money and really need financial advice, you're not going to come to an advisor then, because the very tech that you're using at the moment is where, back to the advisor on the call today, they're going to go onto YouTube and all sorts of different areas to get advice and help on investing. And do we end up becoming irrelevant as an industry at the very point, again back to your point on valuations for businesses, the very point where we're maybe looking for exit strategies, the money is moving out the door into something else and somewhere else.
Yeah, no, I think that's a very, very, very real issue. I mean, I think you've also got it also runs contrary to so many other messages that we have in mainstream investing, like, for example, you can't time the market. Well, you absolutely need to time the market with crypto. You absolutely got to work out what your strike price is and when you're getting out. And I suspect there's loads of people don't think about that. I mean, they're engaged and they're looking at it every day, but they wouldn't have the slightest idea, when to take risk off the table, what taking risk off the table actually means, what would therefore be sensible. And so I think, again, that takes you right back to the educational point, isn't it? It's a way of engaging in a subject that they want to talk about, not in a critical way, but just explaining some of those other concepts that are going to be far more helpful as things progress.
You're absolutely right, because we all know that it only took one dodgy tweet from a well-known car manufacturer to send the price in an interesting direction. So
he sometimes forgets he actually does run a publicly listed company. But anyway, these rules have been there for some time.
Yeah, great way to describe volatility, isn't it?
Yeah, it is.
So again, back to this whole sort of education piece. But we've talked a lot about the next generation and what else do we need to do? So many advisors that I'm now working with have really started to think about treating this as a new segment and how do we build a proposition. Now, you mentioned up front, mortgages and protection requirements. Many of these are doing buy-to-let mortgages. They are thinking about protection. Mortgages, and I remember buying my first house, it's such an emotional purchase. You absolutely remember the people that helped you with that in terms of professionals. So it's just a great opportunity, isn't it?
Yeah, I think we regard it as absolutely vital, and the protection that sits alongside that. I mean, every single one of our new purchases has to be accompanied. Our advisors have to discuss protection, have to evidence that that's been done. So it's naturally taking you in that route. Likewise, every bit of servicing that we're doing with clients who have children just now, I mean, the amount of written business that I see coming through at 3,600 as the junior ISAs put in place, or the small pension contributions being made, and that starts to give us a way to talk, because they own something. Investments actually been made on their behalf. So I think all three of these are absolutely vital. I think if you don't have propositions there, and you are in the zone that all you can do is something regular savings or investment related, then it's going to be a long, slow burn before you eventually see some return on it. But mortgages are perfect, because everyone in their mid-20s wants to get into the property market. They invariably have patchy earnings or problems around mainstream lending, or can often, and therefore advice around it is a real added value thing. They perceive it to be valuable.
Absolutely. And the other area that I'm seeing an interesting shift is charges, where I'm seeing advisors who are engaging with that next generation. If they are giving simple protection or mortgages or even ISA advice to that next generation and helping them to start to save, they're charging what they're calling holistically. So they're doing it at no charge for that next generation as part of a kind of family charge, for want of a better description. Is that something that you're seeing as well, Philip?
Yeah, we do, but I mean, so the sorts of investments that I was talking about earlier on, we wouldn't be charging for them anyway. In the same way as regular savings, we wouldn't be charging for either. We would just see that as a natural adjunct to the existing relationship itself, and a vital part to protecting that relationship. So we've never seen it as essential for that to wash its face at the time you're giving that advice.
Yeah, and the other area, investment solutions, obviously it wouldn't be a session from Schroders without talking about investment solutions, but again, advisors are saying that if they are doing some early savings and investing, then talking about sustainability is a great conversation opener. We've all lived through the recent COP26, and it's certainly got climate change and environmental challenges on the agenda. They said that discussing how people's investments can actually contribute towards addressing this is making some really interesting conversations with that next generation. Again, is that something you're finding, Philip?
It is. I mean, and we have a proposition there. We'd be much more reactive on it, I think, rather than proactive on it. I mean, our core investment solution is different. It has sustainability and things built into it, but it's not its principal marketing hook, if you like. But we haven't. Yeah, you need to have it, I think. It's a hygiene factor, largely, for that cohort.
And then technology, I've seen some great examples of advisors using, apps, for example. Obviously, Skype, Zoom, we're all much more used to doing that now. Again, you mentioned getting wider families on Zoom calls, but also some of the apps like Money Hub, where you can white label it, give that to the next generation to engage. Again, to do that, just to make sure that it's the advisor's brand in front of that next generation, allowing them to look at any savings and investment, giving them nudges and stuff. So one of our messages is always, try not to do all of this yourself. There's lots of partners out there that you could work with to look at how you can do it. But the last point is also interesting, this whole piece around skills and approach. How do we engage with that next generation? How do we speak to them? But how do we also speak to that wider family? Because some of the family conversations can be tricky, can't they, in terms of people don't always want the next generation to know how much money is potentially there. And what happens if they need to go into a care home and have passed the money on. So there's some really interesting and potentially challenging conversations that advisors are now telling me they're having, but need to make sure they've got the right skills in place to do that. Is that something you're also finding?
That's always going to happen, but I think that, some of the technology that you've talked about there, I mean, our portal mechanism that we're about to launch shortly will give us an ability for clients to log all of their essential information, not just stuff that we look after, but insurances and wills and so on and so forth, and therefore all their finances are in one place under my branded thing. And that's a perfect way to be engaging with the next generation, provided the family's comfortable with it, obviously. That says, in the event of anything happening, you don't need to ferret around in boxes or look for bits of paper. We know it's all there. Just come to us and we'll help you through it. And I think that technology becomes really game changing, I think, in terms of our ability to bind that whole unit together under our support.
Yeah, really powerful. And I do think over the next few years, as technology continues to advance, then we'll see a lot more happening in that space in terms of how we can use it to engage the family and particularly the next generation. I mean, we know they're already well engaged with technology. How can we harness it ourselves to make sure that we're absolutely in front of them at the right time? I think it's really important.
Yeah, agreed.
So I guess in our summary, we can move on in a minute or two to take some questions, but certainly for us here, the three key, I guess, areas to consider is, that whole engagement piece, because if we don't, somebody else will. The educate and be educated, and then how do we adapt business models to just take account of all of this? But I guess the overriding comment is, whilst everybody's out there investing, or the young people, in Bitcoin and crypto and all sorts of things, let's not ignore it and just pass it off as, let them do what they want until they've got some money. I think there's some huge opportunities here to think a bit differently, but to be on the front foot. Otherwise, they will definitely be part of the 65% when they inherit wealth that won't use the parents' advisors. So and that will have some impact on the business. I mean, clearly, before we just move on to some Q&A that I think Andrew's going to chair, recapping on the learning outcomes. What is the rise of investing? What does it look like, and why are they doing it? Is it an issue for the business, and how might it relate to your wealth transfer, or actually we should call it wealth retention strategy, and how you might try and address the challenge. Here at Schroders, we've got lots of things that we can offer you to give you some support in terms of guides, some videos. We do run, if we manage to convince that next generation to put a part of their portfolio into multi-asset solutions. We have got our new Schroder Investment Solutions business, which is model portfolios and multi-asset funds, and we're always more than happy to speak to anybody about those. This is just our fee structure. But we have got a website. You can get in touch with us and we can give you more information about that, or any of the topics that we've covered on this session this morning. Andrew, do you want to move us on to Q&A?
Yes, absolutely. So Gillian and Philip, thanks very much. I think we all agree that, it's been a really insightful and thought-provoking discussion so far, and it really is a challenge that we need to meet in the industry. So Q&A, just to repeat, do please type any of your questions in the chat box, and I'll pick up on those and ask them to our two speakers today. A couple that came in. One, so the first one from Simon Humphrey asked, what percentage of UK adults are using a financial advisor? I had a quick check. Any guesses, you two guys?
No, scary. Not enough.
Not enough would be the answer, yeah.
Well, absolutely not enough. So according to the FCA, 1 in 10 or 9% of UK adults, that's 4.5 million people, have used a UK financial advisor in the last 12 months. Okay. So there's a very big audience out there that are not. We've talked, or Philip, you talked a little earlier on about the difference and the importance of this whole question, dependent on whether your business is driven by the need for, or the desire for, capital appreciation, or whether it's a purely income-driven business. Assuming that it's a capital appreciation driving your motivation, what are the three things out of all of this that really an advice business should do to connect with this millennial and Gen Z audience? Philip, let me ask you first.
Do you want three from me, or just one from me and one from Gillian? And well, let's see where we get to.
Try one first. And
try one first, yeah. So, well, I think the first thing is, like you do in any form of business planning, is get a plan. Sit down and think about it. Don't just go off half-cocked and start to bang stuff out, really. I think you've got to work out, what are you trying to achieve by doing it? What's the audience that you're speaking to? And what are you going to say to them? And if it's, if yours is entirely an investment business, then that's going to be built around investment content, investment topics, and trying to engage. If you're a more broadly based business, then I think it offers more opportunities to engage in stuff that cohort will really care about, like, can you help me buy a house, or can you make sure I'm adequately protected? So I think the first thing I would be doing is write a plan to work out, who am I trying to speak to? What's the purpose of me trying to speak to them? What am I going to say to them, and how am I going to execute it? Would be step one.
Very good. And Gillian, how about you? Your thoughts on that?
Yeah, I mean, well, first of all, absolutely echo Philip's thoughts, because, and also it's this is the time of year, isn't it? We get to the end of the year and we get a bit of time over Christmas, so maybe the timing is right to sit back and get away from what feels like a bit chaotic at the moment, in a good way. But it's a great time to write a plan, isn't it? That sort of thought process at the beginning of the year or the end of the year, to think about what does next year look like. So get a plan and a bit of a strategy in place. I mean, what I would always say is, first of all, it's that sitting back, recognizing, do we have an issue in our business, or actually, what I'm seeing now is many advisors really starting to take this on board and do some great work in this area, particularly engaging the wider family and thinking about how we do that in a way that everybody's comfortable with, because many people are really cautious about speaking to the next generation about passing on the wealth. Particularly, we've seen statistics recently, haven't we, around unequal distribution of wealth across that next generation for all sorts of reasons, or skipping generations and people don't know about it. So, is everybody really clear about what's going to happen and who is involved in that process? So, things like, who is the lawyer? What do we have a power of attorney? Is there a will? Where is it held? Some really basic, simple stuff that can help engage that next generation. So I think the starting point for many advisors that I've worked with is getting that audit done. How many people have I really got in each of these later life segments? And what might be the issue? Do I have a business that's absolutely skewed towards that next the existing generation? And how engaged am I in the next generation, like being really truthful about it? And many of them have come back and said, I was really surprised at what the analysis actually showed me. And it doesn't need to be complicated analysis, can it? It can be quite simple, back of the envelope stuff.
Yeah, and I think by extension, to give some thought to when the potential touch points might be. So for example, the moment a life policy is written in trust, or there's a trust wrapped around investments, if any of the children or younger generation are sitting as trustees, the first thing I'd be doing is picking up the phone to explain what the duties of a trustee are. It's just a way to start to forge a relationship about something that's concrete, isn't it? So I think there'll be all these sorts of potential touch points. And just as we've been talking today, it's just dawned on me actually that Q1 next year, I think we might run a mortgage seminar, mortgage masterclass, and just write to all the clients to say, we're going to do this. If any of your kids are thinking about buying houses, join us for 45 minutes and we'll give you a bit of a backstory to what the market's currently looking like and how advice can help you source what you want. It might work, it might not, but it's just another way of getting a touch point going.
Yeah, you're right. I mean, I've talked a number of times about the advisor that I spoke to at an international conference, and he said, this is really extreme, but we engage the next generation from the age of 10. Now that is scary, but he said we just make sure they know who we are. That's as simple as that. But what we also then do is we keep track of their age, and when they get to the point where we want to teach them some really early finances, we bring them into the office in groups and they get to almost know each other. He said, but when they become students, we absolutely talk to them about student loans and debts and what that looks like, and sharing a rented accommodation and what does that look like, and then what is a mortgage. So he said, we're almost want to be with them every step of the way. And he's really honest. He said, I won't make a penny out of that. Absolutely not. He said, but it's absolutely about future-proofing the business that I and my colleagues have spent many years working really hard with clients to create and protect their wealth. And we want to do a good thing apart from anything else, not just about their business, but we want to be delivering true family advice. So, but I think 10 might be a bit extreme, I have to say.
Yeah.
We've just had a question from Namita, who says, so what are the ways, conversations, engagement methods that have been successful with the younger generation who just want to invest in crypto? Hopefully, Namita, that discussion between Philip and Gillian over the last couple of minutes has gone some way to answering that question. Do you guys have any more to add to that?
I don't think so. I mean, I mentioned one, when we were talking earlier about trying to, get that £100 moved, tilted slightly, not to say don't put it in crypto and bang it all into, mutual funds or whatever, but to say, well, leave 75 in crypto and put 25 somewhere else, and just start a conversation around, a blended, a more structured approach to savings. It strikes me. I mean, I've not got any specific evidence of, we've not had a specific conversation where, somebody of that age is coming in as, has only wanted to invest in crypto. But I think that's how I would tackle it.
Yeah, the key thing really then is all about, being aware that this is a phenomenon that's out there, and understanding that you really need to be connecting with these kind of people, this age group, in different and more innovative ways, so that you can help them, earlier in the journey.
Yeah, because I have to admit, Andrew, I took the wrong approach with them. Obviously I'm not an advisor, but I took the wrong approach when my son admitted that all his savings was in crypto, which was, if you don't move it now, I'll stop your allowance, because I don't want any of the any excess of the, sorry, not terrible. I don't want any excess being invested in that way. And let's have a conversation about multi-asset diversification and risk. And he's like, what are you talking about? Which did make me think, I need to approach this from a different angle. But
did you also send him to his bedroom and ground him for 3 days?
It was a very interesting conversation, but it really did prompt the whole debate about investing and not putting all your eggs in the one basket. I tried to describe diversification as, if I'm running a shop on a beach in the UK, do I sell deck chairs or do I sell umbrellas? You hedge your bets. So, I think there's just ways of thinking about how we engage, but I absolutely admit I did the wrong thing, because I was like, oh no, you're not doing that. So so
especially when he came back and said, well, I've already had more than 5 times my allowance over the last half an hour.
Yeah, exactly.
The problem is what's going to happen over the next 24 hours and onwards. So another question here from Michael Cope. How do you think raising ESG and SRI will help with engagement and encourage to diversify back towards equities, bonds, etc.?
It's probably more for you, Gillian, maybe?
Well, I think the whole ESG conversation is really interesting. I know what we find is that, particularly when we talk about the actual companies that we invest in and why we invest, obviously it's hugely on the agenda, isn't it, at the moment? And when we talk about companies that we hold that might seem strange, so particularly companies where they're in transition and we invest to help them move towards, say, net zero in terms of carbon emissions, or help them to address some of their staff, their policies. I think we have a different type of conversation, and that's what we're finding really interesting when we talk about specific holdings. We find certainly advisors are engaged, and they're saying, that's a really interesting conversation that we can have with people, because what we're also finding now is that whilst, if you think about ES and G, whilst the conversation's always predominantly been on E, because I think it's E is for easy, isn't it? We can understand climate change and environmental challenges. The S and the G, what we're finding now, are becoming more on a par. So people are understanding things like, the one I use, sorry, back to my son, was, who would have ever thought that Nando's would run out of chicken, right? And that's a supply chain challenge. So that's what sustainability is around, isn't it? And governance and processes, and look at what's happened with some of the modern slavery issues. So I think we can have really interesting conversations with the young people about what ES and G actually stands for. So I think it's a great conversation opener. It's just finding, isn't it, the opportunities for us to do that. But hopefully it will encourage. I still think people often don't understand how their investment actually can make a difference, and that's about us as an industry engaging and also then reporting on it, because if we say we're going to engage with companies and help them transition, we need to absolutely demonstrate what we're doing.
I could also be very, very cynical here and say that the environmental effects of cryptocurrency are beginning to be quite well documented, but seem to not matter one jot relative to 10,000% return in 2.5 weeks, strangely enough.
You're absolutely spot on, isn't it? And I'm just beginning to learn about all of that. I couldn't understand at all what mining for crypto meant.
Mining uses electricity, I'm afraid.
Yeah, I think it does. So I think there's some really interesting conversations to be had there around that whole piece, but it's that wider engagement. It's the wider engagement piece. And again, that's something that we're doing constantly and want to try and focus on as we move into 2022 is how can we help everybody to have these broader conversations about the whole, the ES and the G. And I think obviously, as we see things like the FCA consultation in terms of some of the labeling, that's going to make for some interesting dialogue in 2022 as to how, what do we use to describe ES and G and sustainable investing for clients.
Okay, we're approaching the end of our session now. It's just before 2 o'clock. I can't see any further questions here on the chat function. Philip, I wonder if there were any outstanding questions you might have. We've perhaps got time for one more.
Well, I think we've probably covered it. I mean, I think I go back to my original comment. I think I've got no criticism with anybody that runs a business to generate income. That's absolutely fine, and carry on. And I think some of these things are still worth engaging with because I think we'll generate more income, eventually. But I think anybody that's trying to build for capital value, I think we need to have a coherent and sensible plan for how we're going to engage with that generation, and we need to do it pretty quickly because the lunch eating is happening as we speak.
Yeah, and you know what? I think it's a really good point to end on. We've recently at Professional Advisor been running some events which sort of talking about sort of succession planning and how businesses are valued, and I think that's so crucial in terms of building value in your business. So I think we'll wrap it up there. Thank you for your questions and to our two excellent speakers for a really valuable session. Just before I do sign off though, let me just remind you of some dates for your diary over the next couple of months. So for those of you watching this lunchtime who perhaps are based in the north, next Wednesday, the 8th of December, we'll be running our flagship conference, PA 360 North, at the Mere Hotel in Knutsford. It'll be the biggest management conference for financial advisors in the north of England this year. And as well as hearing Gillian present, you can also hear over 30 different speakers discussing the key management issues of running a modern advisor business. You'll see Philip there too, I might add. After the Christmas break, we're quickly back into action with our first working lunch of 2022 on the 19th of January, where we'll be partnered on that occasion by Baillie Gifford. We're announcing the details of that session very soon. Certainly they draw a good audience, and that'll be one not to be missed. And then in the last week of January and first week in February, we'll be running our traditional Q1 multi-asset roadshow, where we'll visit Harrogate, Warrington, Birmingham, Bristol and London, with presentations from 5 different investment houses and a keynote presentation from the Advisor Centre's Managing Director, Peter Toogood. And if it's CPD you're after, that's a total of 11.5 hours of CPD over the next 2 months we can deliver to you, with some really great and strong sessions and good networking opportunities too. So that is it for today's session, and indeed that's it for our Working Lunch series for 2021. All that remains for me to do is to thank Gillian and Philip for what I hope you'll agree was a really interesting and certainly thought-provoking discussion. But let me reserve the bulk of our thanks to you, our readers, for your company this lunchtime. I trust that you found this helpful and worthwhile. And if you did, then we'll look forward to seeing you again, maybe even as soon as next week at PA 360 North. Bye-bye.